Welcome to this fundamental lesson on the language of numbers, double entry bookkeeping. This system isn't just a technique, but the very lifeblood of every economic activity. It's the tool that allows us to fully understand a company's financial health. Double entry bookkeeping is the universal language through which companies communicate their economic and financial situation. Through it, every transaction is recorded in a structured and understandable way. It allows us to read and interpret data, transforming it into valuable information. Understanding double entry bookkeeping is essential for anyone who wants to understand how a business works. It's the key to deciphering financial statements, analyzing performance, and making informed decisions. Without it, the corporate world would remain a mystery. For you students of economics and technical studies, double entry bookkeeping is more than just a topic of study. It's the foundation for correctly interpreting financial statements, crucial documents that tell the financial story of a company. Learning to read them means acquiring a distinctive skill. This method is essential for analyzing costs and revenues, factors that determine a company's profitability. Understanding where money goes and where it comes from is essential for effective management. Double entry bookkeeping provides you with the tools for this analysis. Ultimately, double entry bookkeeping is crucial for making informed decisions both at a business and personal level. It allows you to evaluate the viability of an investment, the effectiveness of a strategy, or the sustainability of a project. It's a skill that will stay with you throughout your life. The heart of double entry bookkeeping lies in its fundamental principle, balance. Every single financial transaction, no matter how simple or complex, always generates a double effect. This is the core concept that makes it so powerful and reliable. Every transaction is recorded in at least two different accounts, always maintaining perfect symmetry. No single economic action impacts only one aspect of the company. This system reflects the reality of transactions. One of the effects of this operation is recorded in the debit section of an account. The debit represents the use or increase of resources or the decrease of sources. It is the left side of the account. The other effect, complementary to the first, is recorded in the credit section of another account. The credit represents the source or increase in sources or the decrease in uses. It is the right side of the account. This duality ensures a constant and uninterrupted state of accounting equilibrium. The sum of the amounts recorded in the debit account must always match the sum of the amounts recorded in the credit account. This is the basic principle. This balance is reflected in the fundamental accounting equation, assets equal liabilities plus net worth. This formula represents a snapshot of a company's financial position at a given point in time. It's double entry bookkeeping in a nutshell. Let's now delve deeper into the meaning of debit in accounting. The debit represents the use of company resources or how the company uses its funds and assets. It's the side that shows where resources have been allocated. In simpler terms, debit refers to what the company owns or acquires. It refers to assets, such as tangible property, accounts receivable, or cash on hand. It's the part that reflects investments and property. The balance of an account increases in the debit direction when the company acquires goods or services. For example, the purchase of goods, machinery, or real estate is recorded in the debit direction. This increases the resources available to the company. Similarly, the debit line increases when the company incurs costs. Salary payments, rent, or utilities are examples of costs that are recorded in the debit line. These represent the use of resources for operating activities. Let's now move on to the credit side, the other side of the accounting coin. The credit side represents the company's sources of financing, that is, where the resources the company uses come from. It's the side that indicates the origin of the funds. In other words, credit refers to where the resources originated. It refers to liabilities such as debts to suppliers or banks, and net worth such as share capital. It's the part that indicates obligations and equity. An account's balance increases in credit when the company obtains financing. For example, a bank loan or a capital increase are recorded in credit. This increases the available sources of financing. Similarly, the credit line increases when the company generates revenue. Sales of products or services or the collection of interest income are examples of revenue that is recorded in the credit line. These represent the inflow of new resources. To properly apply double entry accounting, it's essential to understand the nature of the different types of accounts. Each account has a specific function and reacts differently to financial transactions. This distinction is crucial for accurate recording. There are three main categories of accounts that every student should master. Each captures a different aspect of a company's economic and financial life. Let's look at them in detail. Income statements record a company's expenses and revenues. They are income statements that measure operating performance over a given period. They tell us whether the company is generating profits or incurring losses. These accounts are essential for determining the financial result of the financial year, i.e., profit or loss. At the end of the accounting period, their balances are transferred to the income statement to calculate net profit. Financial accounts, on the other hand, record changes in cash and similar assets. They include cash, bank accounts, and operating receivables and payables. They reflect the company's monetary movements. These accounts are essential for monitoring the company's liquidity and solvency. They show how much cash is available and what short term financial commitments it has. Finally, the balance sheets record the company's assets, liabilities, and net worth. They represent the company's financial and equity structure at a given point in time. They form the basis for preparing the balance sheet. These accounts provide a snapshot of the company's financial position. They show what the company owns, what it owes, and what the net worth is to the owners. Double entry bookkeeping goes far beyond simply recording transactions. It's not just a system for recording financial events, but a powerful internal control tool. Its intrinsic structure guarantees accuracy. The constant balance between debit and credit acts as a self checking mechanism. If the sum of the debit and credit accounts doesn't match, we immediately know there's an error. This makes it easier to identify inaccuracies. This intrinsic feature ensures the reliability of accounting data. A balanced system is one that faithfully reflects economic reality. Double entry bookkeeping is therefore synonymous with transparency and fairness. To master double entry bookkeeping, theory isn't enough. It's a skill that requires constant practice and application to real world situations. Only through practice can you acquire the necessary fluency. It's essential to practice with practical examples and analyze different types of business transactions. Every transaction, from the purchase of raw materials to the sale of products, must be broken down and recorded correctly. This strengthens understanding. Today, learning is facilitated by the use of accounting software. These tools allow you to immediately visualize the impact of transactions on the financial statements. They are a valuable tool for understanding the underlying logic. In short, double entry bookkeeping is an indispensable tool for managing any business. It's the backbone of accounting, allowing you to monitor, analyze, and make informed decisions. Its logic is universal and timeless. For you economics and finance students, understanding it is a fundamental step. It's the foundation upon which you'll build your professional skills. Mastering double entry bookkeeping means acquiring an essential understanding of the business world.